Welcome to episode 10 of the MLO Exam Prep Podcast. In this episode, we'll focus on the role of government in mortgage lending, government-backed loan programs, FHA, VA, USDA, conventional versus government loans. Let's get started. The role of government in mortgage lending. Why does the government involve itself in mortgage lending? The government helps to increase home ownership by making mortgage loans more accessible, provide loan programs for first-time buyers, low-income borrowers, and veterans. Ensure market stability through loan insurance and guarantees. What are government-backed loans? Unlike conventional loans, government-backed loans are insured or guaranteed by federal agencies to protect lenders from losses. FHA loans, backed by the Federal Housing Administration. VA loans, guaranteed by the Department of Veterans Affairs. USDA loans, backed by the U.S. Department of Agriculture. Exam tip, a test question may ask, which government agency backs FHA loans? The correct answer is the Federal Housing Administration, FHA. FHA loans, Federal Housing Administration loans. Key features of FHA loans. Low down payment requirement, 3.5% with a 580-plus credit score. More lenient credit requirements than conventional loans. Requires mortgage insurance premiums MIP, available to first-time and repeat homebuyers. FHA mortgage insurance. Borrowers must pay two types of mortgage insurance premiums. Upfront mortgage insurance premium, UFMP, 1.75% of the loan amount paid at closing. Annual mortgage insurance premium, paid monthly and required for the life of the loan if the down payment is less than 10%. FHA loan limits. FHA loans have maximum loan limits based on county property values. Loan limits adjust annually and vary by location. Exam tip, a question may ask, what is the required down payment for an FHA loan with a credit score of 580 or higher? The correct answer is 3.5%. VA loans, Department of Veterans Affairs loans. Who qualifies for a VA loan? Active duty military, veterans, and eligible spouses. Borrowers must meet service requirements, e.g., at least 90 days of active duty during wartime. Key features of VA loans: no down payment required, no monthly mortgage insurance, MIP, or PMI. VA funding fee applies unless the borrower is exempt. More flexible debt-to-income, DTI ratio requirements. VA entitlement and loan limits. Eligible veterans receive a basic entitlement of $36,000 and a secondary entitlement for homes over conforming loan limits. There are no official VA loan limits, but lenders may impose limits based on creditworthiness. Exam tip. A question may ask, what is the required down payment for a VA loan? The correct answer is 0%, no down payment required. USDA loans. U.S. Department of Agriculture loans. Who qualifies for a USDA loan? Borrowers purchasing homes in eligible rural areas. Income must not exceed 115% of the area median income. Key features of USDA loans. No down payment required. Guaranteed by the USDA to encourage rural home ownership. Must meet income and geographic eligibility requirements. Requires an annual guarantee fee similar to mortgage insurance. Types of USDA loans. 1, guaranteed loans, funded by private lenders, backed by the USDA. 2, direct loans, funded directly by the USDA, available to low-income borrowers. Exam tip. A test question may ask, what is a key feature of a USDA loan? The correct answer is no down payment required. Closing thoughts on Part 1. Key takeaways. FHA loans require low down payments but include mortgage insurance. VA loans offer 100% financing with no mortgage insurance for veterans. USDA loans provide zero down options for rural homebuyers. In Part 2, we'll cover conventional versus government loans, PMI versus MIP versus VA funding fees, choosing the right loan program for borrowers. Stay tuned. Welcome back to Episode 10 of the MLO Exam Prep Podcast. In Part 1, we covered the role of government in mortgage lending, government-backed loan programs, FHA, VA, USDA. Now in Part 2, we'll discuss conventional versus government loans, PMI versus MIP versus VA funding fees. Choosing the right loan program for borrowers. Let's get started. Hack conventional loans versus government loans. What are conventional loans? Conventional loans are not insured or guaranteed by the government. They follow guidelines set by Fannie Mae and Freddie Mac. Borrowers must have stronger credit profiles and larger down payments compared to government-backed loans. What are government loans? Government-backed loans are insured by federal agencies like FHA, VA, and USDA. They offer lower down payments and more flexible credit requirements. The government absorbs some of the lender's risk, making loans easier to qualify for. Exam tip: a test question may ask, what is the main difference between conventional and government loans? The correct answer is, conventional loans are not government insured, while government loans are backed by agencies like FHA, VA, or USDA. PMI versus MIP versus VA funding fees. Private mortgage insurance, PMI, conventional loans. Required when the borrower's down payment is less than 20%. PMI protects lenders in case of borrower default. PMI can be removed once the borrower reaches 78% LTV or requests removal at 80% LTV. Mortgage insurance premium, FHA loans. FHA requires both upfront MIP and annual MIP. UFMI, 1.75% of the loan amount paid at closing. Annual MIP, paid monthly and remains for the life of the loan if the borrower puts down less than 10%. VA funding fee, VA loans. VA loans do not require mortgage insurance. Instead, a VA funding fee helps cover the costs of the VA loan program. The fee varies based on down payment amount and first time versus subsequent use. Some disabled veterans are exempt from the funding fee. Exam tip: a test question may ask, when can PMI be removed from a conventional loan? The correct answer is automatically at 78% LTV or by borrower request at 80% LTV. Choosing the right loan program for borrowers. When should a borrower consider an FHA loan? Lower credit scores, as low as 580 for 3.5% down. Smaller down payments. More lenient debt-to-income DTI ratios. When should a borrower consider a VA loan? Eligible veterans, active military, or spouses. No down payment required. No mortgage insurance, MIP or PMI. When should a borrower consider a USDA loan? Buying a home in an eligible rural area. No down payment required. Meeting income eligibility requirements. When should a borrower consider a conventional loan? Strong credit score, typically 620 plus. Ability to make at least a 5% down payment or 20% to avoid PMI. Shorter loan term preferences, e.g. 15-year fixed. Exam tip: a test question may ask, which loan program is best for a borrower with strong credit and a 20% down payment? The correct answer is a conventional loan to avoid PMI. Final exam-style quiz questions. 1. Which of the following is a key difference between FHA and conventional loans? A. Conventional loans require lower credit scores than FHA loans. B. FHA loans require mortgage insurance, while conventional loans require PMI only if LTV is above 80%. C. FHA loans require a 20% down payment. D. Conventional loans require government approval before closing. Correct answer B. FHA loans require MIP, while PMI is only required for conventional loans above 80% LTV. 2. When can PMI be removed from a conventional loan? A. After 5 years. B. When the borrower reaches 78% LTV automatically. C. When the borrower requests removal at 85% LTV. D. Never. It remains for the life of the loan. Correct answer B. PMI is removed automatically at 78% LTV or by borrower request at 80% LTV. 3. What is a key feature of VA loans? A. They require a 5% down payment. B. They require private mortgage insurance. C. They require a funding fee but no monthly mortgage insurance. D. They have strict income limits. Correct answer C. VA loans require a one-time funding fee but no mortgage insurance. 4. What is a primary advantage of USDA loans? A. They require a minimum 3% down payment. B. They have no income restrictions. C. They are available in urban areas. D. They require no down payment for eligible borrowers in rural areas. Correct answer D. USDA loans offer 100% financing for eligible borrowers in rural areas. Closing thoughts on Part 2. Key takeaways. Conventional loans require stronger credit and larger down payments but allow PMI removal. FHA loans require MIP for the life of the loan if less than 10% is put down. VA loans require no down payment or monthly mortgage insurance but do require a funding fee. USDA loans offer no down payment but have income and location restrictions. This concludes Episode 10, Government Loan Programs and Conventional versus Government Loans. In Episode 11, we'll cover mortgage-related laws and consumer protections, TILA, RESPA, ECOA, and more. Final review of mortgage law compliance. Thanks for studying with us. You've got this.